Goedemorgen allemaal. Welkom bij het CFO-webinar. Ik kan jullie niet zien. Jullie kunnen mij wel zien en mijn collega aan de linkerzijde, Praveen, kunnen jullie ook zien. I'm going to switch to English straight away. So that's nice that Praveen can also follow what I'm saying. My name is Maier van der Schaaf. I'm a partner at consultancy firm IndiaConnected in Amsterdam. And we work closely together with Maier+Vidorno, which is a firm set up 20 years ago in New Delhi by a German fellow, Klaus Maier. And Klaus is still managing director at AM MEZ. Together, IndiaConnected and AM MEZ, we offer a broad number of services, ranging from market research to searching distributors, recruiting salespeople. We offer legal support, financial support. We help with setting up manufacturing units. Basically, you name it, whatever you need, almost as a foreign company, specifically to become successful in India. Yeah, we can help with that. Today, of course, we're going to zoom in with the CFO of Maier+Vidorno, Praveen Singhal, on all financial topics. It's a special day actually in India. Saturday will be Diwali. That's can be compared to our Christmas. And today they just had a luncheon at the office. So it was also the first time again that a lot of the employees saw each other again after all this home working due to COVID. Praveen will share quite a lot of information with you. If you cannot follow at some point, don't worry. We will record this session and we'll share the video file afterwards with all of you. If you have questions, you probably have noted already that you are all in the mute, on mute. And if you have questions, you can ask them in the chat box. So this is still a map of where we are in India. We have four locations, founded in 2000, 150 employees. And we are exclusive partner for the Netherlands, and Maier+Vidorno also has partners in the US and Japan, and they're obviously strong in German markets. Before we start, it's nice to we have prepared a quick poll. So just 3 questions, so you also know what kind of other people and other companies are in the room with us today. So Atul, if you can share the poll. So please click yes or no. And if everybody clicked, we can go to the second question. So for how long has your company been active in India? Is that less than a year, less than 5 years, or more than 10 years? Please fill it out. So under poll, we can actually see that there's 76% is already active for more than 10 years. So we have quite an experienced audience. If we go to the next question, Atul. Atul, can we go to the next question?
I think Martin connection is lost. Please wait for some time. Praveen sir, you can carry on with the topics.
Okay, okay. So shall we wait for Martin? No, I think so we can continue.
We can continue.
Okay. Good morning, everyone. My name is Praveen Singhal. I'm working as CFO at Maier+Vidorno. Finance and tax is my responsibility, which I take care over here. Already a brief introduction about Maier+Vidorno and IndiaConnected is already being provided by Martin. I'm working a bit about me. I'm a chartered accountant and I'm working with Maier+Vidorno for now more than 10 years. And I'm based out of headquarters of Maier+Vidorno, which is in Gurgaon, basically a part of Delhi NCR region. Yeah, hi Martin. We started actually we lost you in between, but we started. I think so.
I noticed. Thanks for starting.
Okay, okay. So today, some topics which we would like to cover. We will speak about the taxation system in India. We will also speak about what are the profit repatriation options that we are having from the India to abroad, and we will also speak about the funding options of the Indian subsidiary. And these are the usually most relevant topics which normally a finance guy sitting in abroad, which they are more concerned about their Indian entity. So we will speak. We will not go in that deep because topics are very broad. So we will try to have some basic key overview of the systems and some options. And some more details are required. We are very much here to help, or if any needs are there. So going forward about the tax. So in the tax, we will speak about direct and indirect tax structure, which we are having into India. And this is very much normal as compared to any other European country. Direct tax is like income tax or property tax, which is paid directly on the income or the profits which a business made or the transactions which are happening. And the indirect tax is levied on the products or services, which is like in India we have GST, which came in June 17, goods and service tax. So it's a combined single levy goods and service tax for both goods and services. Prior to GST, we were having excise duty and VAT. So going in more detail about the direct tax. So normally when we tax the company, we normally divide company into two categories: the domestic company and foreign company. So now the subsidiaries of the foreign companies, they are actually incorporated into India, and they are following the local rules and regulations. So though they are subsidiary company or foreign company, from tax point of view, they qualify as a domestic company. So you can say that all wholly owned subsidiary company of the foreign company into India qualifies as domestic company, and the taxes as applicable to domestic company would be applicable to them. And the foreign companies are the other companies. Maybe Atul, just a back. The foreign company are the companies like who are doing business into India without any legal entity. Typically, like branch office is the one option, project office is another option, or if somebody is doing into business into India and his permanent establishment, the PE, is getting created. So for that scenario, they qualify as a foreign company, and taxes which are applicable for foreign companies are applicable. Yeah, next slide, please. So over here now we will try to compare the differences in the tax rates of foreign company and domestic company. And for domestic company also, actually we have two type of tax structure. And so the chart which you can see in on your screen. So this is the normal tax rate. And over here you can see that the tax rates, we have tax rates, then we have surcharge, we have health and education cess, and then the effective tax rate. So the last column is relevant, effective tax rate column is relevant, and the tax rate is very much dependent on the turnover of the company and also on the profits which the company is making. So you can say that the tax rates are from 26%, effective tax rates from 26% to 35%. But these are the normal tax rates which are there, and now government has taken the additional steps. They came up with special tax rates, and with that you can see next slide. So now over here we will speak about special tax rates, and actually which came in effect from April 19 only last year. The ordinance came somewhere in June or July, and which made this special tax rate effective from April 19. So over here, just we have two categories, and maybe I can say the section 115 BAA, the first category, the second category 115 BAB. The first one is actually applicable for the existing companies already who are paying the taxes, which you see in the previous slide, from 26 to 35%. They can go for this section and they can pay a net rate of 25%. That is irrespective of any turnover, irrespective of any profits. So the flat they will pay around 25.17% tax rate. But there is a small condition that some specified deductions and incentives which actually they were availing earlier, they will not take, they are not allowed to take. They have to forego these specified deductions and incentives if they go for this. So we can try to understand really it makes sense to go for this or not, and we can comment onto that in next slide. The second option is just the previous one, please. Okay. The second option is 115 BAB, which is more for the new companies which are now getting set up into India only for manufacturing. So this is the one new initiative which government has taken for this Make in India promotion, that any new company which is set up after October 19 and which starts the manufacturing before March 23, they can pay the tax rates of 17.16%. So base rate is 15, but after the surcharge and cess, that's become 17. So overall, you can see that there is a difference of 8%. So any new company who wants to start their business fresh in manufacturing, they can go for this. Maybe we have seen that some existing players, if they want to start their new manufacturing plant or want to go for any expansion, they sometimes take the call, create a new company, and start operations over there. So over there, that could be a really, if somebody is into that stage, they can really think of really make sense to do that in their existing setup, or would it make sense to start a new company and start afresh to take the lower tax rates benefits. So this is one key insights. I think so. We see a lot of really companies are going for this. The next slide. So over here, so these are the certain exemptions and incentives which actually now we need to forego if we go for the special tax rates. And if we really see that actually these incentives and exemptions are really, not everybody is not claiming these. These are really not applicable in all of the cases. These are applicable in very selective cases. And normally we make the assessment, or I will say that every company actually need to make the assessment whether they go for special tax rate and forego these exemptions, and it will be really beneficial. So that is, it's sort of a one-time exercise which every company need to do. Compare the old tax rate versus the new tax rate and foregoing these exemptions and take a call. Because this option can be exercised once, means it can be exercised once, now the December is the filing. So before the returns are getting filed, we need to exercise this option. There is a separate form which need to be filled in, and by putting that form, this option can be exercised. Yeah, next slide. So coming to the foreign company tax rates. So now over here you can see what are the foreign company tax rates, which are pretty high as compared to our domestic rates earlier, which are ranging from 42 to 44%. So that's why it really makes sense to start the business by having the local entity. Otherwise, tax rates are really very high at this point of time. Certain tax compliances which we need to do. We need to file the annual return, which is normally 31st of October. And but this year now, because of this pandemic, the date has been extended. Now the date is 31st of January, and for the tax audit report, the December is the last date. So typically, the two compliances are there. One is the tax audit filing, and second is the ITR filing. Apart from transfer pricing, we will speak about transfer pricing in the separate section. Yeah, coming to the transfer pricing. So transfer pricing is very much relevant now. Typically, I will say that for any foreign company, this is a topic, because normally all the companies have certain type of transactions which they do with their daughter companies or sister concerns, and all the transactions which they do with them, they falls into this particular category. So over here, this is again a technical definition. Okay, whatever transactions which are happening between the associated enterprises typically falls into international technical falls into international transactions from transfer pricing perspective. And all the transactions has to be on the arm's length basis. There are certain methods which are specified and which need to be used to make the benchmark, I will say, to judge the pricing of the international transactions. And we will try to understand who are associated enterprises in the next slide. So who are associated enterprises? And so, so this is again a definition which came from our act. our local income tax act. But in the plain terms, you can say that if there is a holding of more than 26%, if there is a control on the board, if control on the board, it can be direct control, it can be indirect control. And then the both companies are actually associated enterprises, and all the transactions which are happening, the cross-border transactions happening, has to be part of the transfer pricing study. Next slide, please. So, what are the type of transactions which actually falls into transfer pricing? So, transfer pricing, the transactions in the nature of like for provision of any services which are getting provided either by a daughter company to a foreign company or foreign company to local company, any sale, purchase of any tangible or intangibles, that is all part of international transactions. Lending of any money, giving the corporate guarantees, that is also part of transfer pricing. Any transactions which actually have a bearing on the income and losses of the any enterprise. All the reimbursements we take, like if we incur some expenses on behalf of parent company or parent company incurs some expenses on behalf of daughter company, all reimbursements are also part of this transfer pricing. So you can say that any type of transactions maybe which don't have any impact on the P&L, still only reimbursements are there that are also subject to the transfer pricing and need to be covered into the transfer pricing audit and study documentation, which we do locally. The next step, please. So how to, we spoke about what are the transactions which falls into transfer pricing, then which are the methods which normally are getting used for the determination of arm's length price. So these methods are very standard. These are used across in Europe also, and in India also we are using the same methods. And so this we need to go for an annual income tax audit transfer pricing perspective, and these methods are then used to justify the transactions which are there. Next slide, please. So about the compliance summary for transfer pricing, what are the compliance requirements? So now over here, I would like to classify this into two categories. One is the audit, and second is the study. So the audit is a yearly requirement. We need to do every year. 31st of October is the last date. And okay, this year again it has been extended till December, but normally October is the last date. And the audit need to be filed in this form 3CEV. It has to be done by a third-party practicing chartered accountant. And all the transactions, international transactions, which we spoke of, even if of more than 1 rupee, need to be captured into this. Like if you're settling the share capital, that is also part of transfer pricing audit report, reimbursement. So any transaction more than a single rupee also need to be captured. It has to be done on the yearly basis. It's a yearly requirement, and it has to be done before the filing of income tax return. Then the second is about the study. Now for the study, it's more about creating the documents. Means when we are justifying any transactions. So over here we create the documents, the basis of justifying the transaction. So this is applicable if transactions are more than 1 CR. 1 CR is around more than 120,000 euro. So if international transactions are more than 120,000 euro in a single fiscal year, then we go for this study. That is mandatory. Below that, it is again more of an optional. But audit is very much required, and we need to keep this into mind for our local compliances. Additional compliances of transfer pricing. These are the recent one which came in 16, which speaks for master file and country by country reporting. But again, these master file and country by country reporting are applicable. That depends on the level of transactions and also the size of the group company. So we need to see the both thresholds, and then only these are applicable. So we can say that it's not applicable in every case. That depends on the level of transactions, international transactions, and then also depends on the level of means the group turnover level of the group company. Yeah, next slide. So over here, I think so we can focus on the last column, the applicability. So like we had the master file, which we normally say 3CEAA is the firm name, our local firm name, and which is applicable if the group turnover is more than 62 million euro, and it's an end condition. If group turnover is more than 62 million euro and international transactions are more than 6.2 million euro, or our international transaction for intellectual IPRs is more than 1.2 million euro. So only in that case, this master file forms are applicable. Otherwise, we need to just fill in the part A. Part A is very basic form. The full master file is only applicable if we had the numbers above these specified threshold limits. Next slide. This is about the country by country reporting, and country by country reporting is only applicable if group revenue as a group is more than 88 million euro. In our local rupees terms is 500 crores, which comes to 688 million euro. If only that is the case, only then country by country reporting is applicable. Otherwise, it is not applicable. So these topics of master file and country by country reporting is really applicable for the bigger size of operations. Otherwise, these are not applicable. The next slide. So coming to our the next topic, indirect tax, which is about GST. I am just covering very basic topics. I am not going into that detail. Otherwise, topics are really very vast. I'm just trying to touch the basic concepts. So GST it came in July 17, which is I would say the biggest tax reform into India. And prior to that GST, we were having the different VAT in the every states. After GST, now there is a one single tax across India, all the states. The only thing in India still we follow this dual GST. Like in GST, we have two components. One is central GST, which goes to center, and we have state GST, which goes to state. So this is more of a bit unique. Normally in Europe, there is only one GST. But over here, because of the federal structure of India, we have more than 28 states. We have this dual GST in place. So, for example, if 18% is the GST, so only 9% is central and 9% is the state GST. Coming for the tax rates, we have just depicted the tax rates, the 0.4, the 12 and 18%. 12 and 18% are the standard rates, more of a residual in nature. 28%, which is in 3, are more or less applicable on the luxury items or the sin goods, we say like cigarettes and all, plus cess on them. And then we had on food and all, which is 5%, on gold, stones, jewelry 3%, and on some products related to agriculture around 0%. So we had these various rates, but normal standard rates are normally 12 to 18%. In some cases, 28% is also there. Still, GST is not applicable on the alcoholic liquor and on the petroleum products. For that, still we follow the old system, which was local excise duty and local VAT. So you can say that still, if our company is dealing into these products, we need to follow the old regime for these items. About the input tax credit, this work in the very same way. which as works into Europe, all the expenses which are getting incurred for the business, the business can take the input tax credit. Then there we need the invoice, some documents, the name has to be there, the GST number has to be there. So it's really works into the same manner as it works in the Europe. The only big difference over here is that we need to really match everything online before we claim the input tax credit. So that's a bit cumbersome. It means we are not relying not only on the documents, we are going a further step more and try to reconcile everything online. Only then the inputs are allowed. But anyway, the mechanism works in the same way. So it is very normal. But still, we have certain cases where inputs are not allowed, and let's see which are the cases where inputs are not allowed. So these we say normally these are the blocked credit. So means when in business we are incurring expenses on these items, still we cannot take any input tax credit. Like in a business, if I am buying the motor vehicle, or if we are incurring on food or beverage either for clients or for staff, if we are incurring expenses for membership of a club, hiring the cars, life insurance of the employees or health insurance of employee. So all these cases, though we are incurring the expenses, though we are incurring for the furtherance of business, but still inputs are not allowed. So we really need to keep this into mind. Still, you can say that when we do the business, still there are certain costs which are getting actually added to the P&L. It's not inputs are not allowed. In the same way, we had if we are creating a office, and when we are creating the office and a building, the inputs on that is not allowed. That is part of boss contract of constructing and making the property. The reverse charge was in the same way. This concept is very also common abroad. Normally the GST is paid by the service provider or the good supplier, but in reverse charge it is paid by the service recipient. The service recipient has to pay the reverse charge. So over here, the certain classic examples which falls into reverse charge, like the import of services. If a daughter company or a local company is having some import of services, we need to pay the GST and the reverse charge. Like services of advocates, sponsorship services, the services of rent a cab, everything falls into reverse charge. So when we do the compliance, we also need to see that which services falls into the reverse charge category. This is a long list of the compliances anyway which we need to do. So GST, though it has really made the India one single tax, but I can say that on the compliance side, it's a little bit more cumbersome. And in the GST, the one thing we need to keep in mind, GST works state-wise. Like if means like in direct tax, I had one single PAN which works in the single across India. In GST, we need to take the registration in the every state where we want to have our own office or where we want to have our own warehouse or our production facility. So then we need to take the GST in the every state, and so there could be a scenario that if we have the offices in every state, then we had so much of GST registration, and then we have so much of GST compliance. So that we really need to consider. Coming to the next topic is about the profit repatriation. I think so this topic would be of much of interest. Over here, we will try to understand what are the options that a foreign company have to have the profit repatriated from India to the home country. So one is the classic is the dividend. Dividend is the one classic of very widely used. We will try to cover that in detail. And one is about the share buyback. One is about capital reduction. Capital reduction is not that popular option, but that is pretty much applicable if for a business which really wants to reduce the activity into India. So that is more of a company who really wants to downsize their operation. That is for them. And the two other regular options are royalty. Means the royalty can be paid by a daughter company to a parent company for the uses of their trademarks or their brand uses, and also payment of services. Services can be for consultancy, can be for IT support, any technical know-how which parent company is providing, any other consultancy of project can be there. So lot of things can be worked out. So now these are the some options which are available for profit repatriation. So coming to dividend, the first option. So dividend is governed by Companies Act 13. So that decides the manner the dividend need to be distributed. Dividend can be a final dividend. Dividend can be an interim dividend. Final dividend normally are declared in the annual general meeting of the shareholders, and interim dividends are declared by the board itself. The method of computing the dividend are also specified in Companies Act, and that you can see in the next slide. So when we are before we distribute the dividend, we need to decide the amount. So when we are computing the amount for dividend, we need to keep certain points into mind, like depreciation need to be provided, the previous year losses, if they are, then they need to be set off, and the dividend cannot be paid if some preference unpaid dividend of preference shareholders are pending. So these are the basic points which we need to keep into mind. And one operational point is that the date we decide in paying the dividend, we need to open a separate bank account, because for the dividend a separate bank account has to be there. So we need to transfer dividend from our main account to the separate bank account within 5 days, and within next 30 days it need to be paid to the shareholders. So this is the mechanism in which the dividend works. About taxation, we will see in the next slides. Over here we speak about dividends declaration in absence of profits. It means there could be a scenario that we don't have the profits in the current year, but in the past we were having a lot of reserves with us. So in that scenario also, that is very much possible. So normally you can say that we can withdraw the 1/10 of the previous reserves and we can pay the dividend from there. The one condition which we need to see is that our average rate of dividend cannot exceed the last 3 years average rate of dividend. And before we withdraw the reserves, 1/10 reserve, we need to set up the current year losses if any. So then in the absence of profit also dividend can be paid. Next slide. That is more about the taxation. So now this is really interesting. Just to give you the background, we were having dividend distribution tax in India, which was around 20% was there. And this dividend distribution tax, which we say normally DDT, has been abolished from April 20. So this has been gone. In the past, when the company were declaring the dividend, and they need to pay this DDT also on the top. So that was additional cost, 20%. But now this has gone. So now once it has gone, now there is a withholding tax. Withholding tax it has come back because when this dividend distribution tax was not there, withholding tax was not there, but now withholding tax has come back. So now when this dividend is getting paid from India to abroad, normally there is a dividend distribution tax, withholding tax of 20%. But when we speak about Netherlands, we had a DTAA in place, double taxation avoidance agreement, and as per the Article 10 of that, the income tax rate of withholding is only 10%. So you can say that the local company can pay the dividends to the parent company in Netherlands, taking the benefit of this Article 10, and the daughter company would be required to withhold only 10% of the amount as a withholding tax. And there are certain documents which are required by the local company to claim give the benefit of this. And these are very standard documents. One is the TRC, the tax residency certificate, which is normally issued by the local authority in Dutch, and the PAN number. The PAN number, the shareholding company need to take it to India. With these two documents, this benefit of this 10% can be availed. Second option is about the buyback of shares. Buyback of shares was a good option till the time this dividend distribution tax was there. But the moment the dividend distribution tax has gone and this withholding tax has come, and which is also 10%, and the buyback is now not that favorable option, because over here from tax side, whenever a company is doing the buyback, we need to pay a buyback tax of 20% plus surcharge and cess. So from tax point of view, it actually is not beneficial. Though theoretically buyback of share is also an option, but from practical point of view, dividend is really one of the most favorable option as compared to buyback of shares. The next slide. Third is about the royalties. Yes, the daughter company can pay the royalty to the parent company or sister company, and royalty is very much the daughter company are using this, and our lot of clients also use this royalty payments, and say it's very normal in process, and it's very widely accepted from the tax side also. The departments also accept these royalty payments, and the quantum of royalty, that is also a topic of transfer pricing. We need to see that how much of royalty we can pay. That only transfer pricing will tell. And normally we say that royalty are paid normally as a part of, based on turnover from 2 to 5% of the turnover. That we don't foresee any issue. And again, from the tax side, when the royalty are getting paid, the daughter company or the local company will deduct withholding tax of 10%, and that is also, there is Article 12 of treaty, which allows that the royalty can be paid having the benefit of that Article 12 and 10% of withholding tax. So royalties can be paid after 10% of net of tax. The same way now for payment of services, the parent company can provide a lot of services to the daughter company, management services. It can be consultancy, it can be IT services, and that it is also very normal. A lot of foreign companies use these options, and it's very normal. It's in practice, very widely accepted. And from tax side, it is also the payment should be made after withholding tax of 10%. So you can say that either we go for royalty, we go for services, or we go for dividend. The withholding tax is 10%. The only thing difference between our services and royalty vis-a-vis dividend, because dividend come post payment of income tax. This payment of services or royalty comes before payment of income tax. Because these are the P&L item. Dividend is not a P&L item. Coming to our last topic, which is about the funding. And over here, we will try to understand the funding options which could be there for the local company for their local operations. So the first option is the investment through shares and convertible instruments, which is a very traditional method. And normally when the business is getting started, this is the first method which company use, where we put the money as a equity shares or as a preference share or as a non-convertible debentures, also sorry, convertible debentures. So these are the very traditional method, and still I will say that when the company are getting started, they use this method. We need to just keep into mind that in certain sectors we have the limits still that need to be kept in mind, and we also need to keep in mind the share price, at what price we are issuing the shares, and the simple regulatory regime of allotment and reporting to be followed. So this is the most classical method of funding the subsidiary. Next slide. The second is the ECB, external commercial borrowings. So this is we see the loans from abroad to the local company in foreign currency. So this is like a foreign loan, which is very much allowed, and a lot of companies use this option. We had separate rules and regulation: who can lend the money, who can borrow the money, how much of interest can be paid, what duration can be there for the loan. So there is a specified regulation for this, which is there from Central Bank, Reserve Bank of India. They issue the guidelines. Whenever a company wants to give the loan, they need to make an agreement. It needs to be approved by the Central Bank, and only then this loan can be provided. So it's a barely controlled mechanism, but still a lot of companies use this because this is a very, I will say that because it has a lot of benefits. The local company can get the loan at a cheaper rate because interest rates are much lower as compared to local rupee loan, and it is also beneficial to the parent company because they can still earn some money on the amount invested, despite the company make profits or not. They had a chance to earn interest at least on the money lended. So it's actually a win-win situation for both. One point which you need to keep in mind is the currency risk. That point we always need to keep into the mind when we go for this, because in India still we see that rupee is really depreciating over a lot of the history says that it's really depreciating over years. So that currency exchange risk need to be kept into mind. Otherwise, then it's really a very win-win situation for the both, the parent and the daughter company. Limits are very big, like till 750 million euro. It can be awarded under automatic route. The minimum maturity period that we need to keep into mind. So normally any loan has to be minimum for 3 years. For working capital, it has to be for 5 years. So you can say that if the loan is provided for capex, capital expenditure, it can be for 3 years, and if it is for working capital, it is for 5 years. Means the principal cannot be paid before 3 or 5 years. Interest can be paid whatever the agreed terms, either monthly or quarterly, half yearly, but principal cannot be paid. So the principal repayment can only start after 3 or 5 years, whichever is the case. And there is a one relaxation which is only for manufacturing companies. If manufacturing company wants the loan only for capex, they can have the loan for a duration of 1 year also, up to 50 million of dollar. So we need to keep this into mind. Equity liability ratios means debt equity, it cannot exceed 7:1. For the smaller loan, this ratio is not relevant. A loan up to 5 million, it is not relevant. And how much of interest can be paid? So the regulations specify the maximum interest. So the maximum interest which can be paid is benchmark rate plus 450 basis point. And a benchmark rate is 6 months of LIBOR, or in case of Euro, 6 months of Euribor also is the rate. 6 months, so 6 months of LIBOR plus 450 basis point is the maximum rate which can be paid, and which we found normally a lot of client companies normally have a lower rate than this. Nobody actually go for this high rate. They normally go for LIBOR plus 200 points or 250 points like this. So, but the regulation allows that. We had certain end use restrictions for this, like the money which is borrowed as an ECB cannot be used for real estate, cannot be used in the capital market, cannot be used for further equity investment. Like the working capital loan has to be from foreign equity holder only. So we need to keep these end use restriction in mind when we borrow the ECB. The third option is about the business arrangement. This is very normal. If we are buying goods or services from parent company, we try to extend the credit terms. That is also one of the mechanism of funding the subsidiary. Or if we are buying certain goods or services from the local company to abroad, so there can be advances for that. But over here, because these transactions are again cross-border, so we need to keep that how much of advances can be there and how much of credit can be there. So we normally say that anything up to 1 year is really manageable. Beyond 1 year, we really need to see the RBI master circular, and we need to follow the process as defined, because otherwise there could be a chance that if we extend the money like this, it can fall into definition of the ECB. Your ECB, like the foreign loan, is a very controlled mechanism. But in this case, in this option, this is fairly uncontrolled. It's fairly open to the business how they structure. The last option is about the local rupee loan. So the local rupee loan can be taken. So either the local books have that strength to go for the local loan, or otherwise the parent corporate guarantee can be provided from the parent bankers to the local bankers, and again that local rupee loan can be arranged. Or nowadays this standby letter of credit SBLC are actually issued by the parent company bankers to the local bankers, and against that local limits are getting set up. So this is also one of the mechanism. The only concern over here is that the rate of interest, just a slide back again. The only concern over here is the rate of interest, because rate of interest over here is a bit higher as compared to the rate of interest in the foreign currency loan. Over here in INR loan, the rate would be something around 9%, 8%, or can go up to 10% also. So that we need to keep it to mind. Otherwise, this also could be the fourth option of funding of local companies. I'm done with my part. Back to Martin.
Yes, thank you, Praveen. As for questions, you can use the chat to pose your questions. I have received before a question, but I think you answered that one on the tax for dividend. But for others, we still have 5 minutes. So if there's still any questions, you can post them in the chat. Let's see if something is coming in. And I also go through the list of questions that was asked when people enrolled. So one of the questions I've seen when people enrolled is how to get access to local bank finance.
Yeah, so Martin, I covered that topic. The local bank finance can be assessed. That means the the most utilized route is the standby letter of credit (SBLC). So the standby letter of credits are issued by the parent company bankers to the local bankers, and the local limits are actually getting set up against that limits. So that is the one option. Another option is the corporate guarantee. The corporate guarantee can be given, and against that local rupee loans can be arranged. So lot of foreign companies use that practice, and it's very normally used.
Right. Let's see if there's anything else coming through in the chat. I haven't seen that. GST needs to be paid directly to the central/local government. Is it normal that this is done via CA?
Means the taxes are paid directly to the government, and it's not required to pay through CA. Means the companies can pay directly. There is no legal requirement to pay through CA. Sometimes some companies, for ease of their convenience, they transfer the money to CA, and then the CA pay on their behalf. But it is not required, and everything is online. And I can tell you from my experience, in all of our cases, all of our client companies, we pay directly from the company to the government account directly.
Okay, so no CA needed.
Yes.
For that. I have another question. I'm quoting her. I wonder what the exact differences are between a dividend payment before the 1st of April 2020 and after that date. Before 1st of April 2020, both India and the Netherlands charged taxes to the dividend, and afterwards only India, since India and the NL have the DTAA.
So there maybe there are no differences how the taxes are handled in Netherlands. The differences are there when we are paying dividends from India, like from before April 20, when India was paying the dividend, there was a dividend distribution tax of 20%, which was getting paid from India. So that was the cost in between. And after April 20, now there is a withholding tax of 10%. So, to give you the example more with the numbers, if a company need to give the 100 euro dividend, and in the previous, before April 20, when they were paying 100 dividend, they were also paying 20 as a dividend distribution tax to the local government. So they were actually paying 120, and only 100 was getting remitted to Netherlands. And on that 100, they were paying the local taxes, which are applicable in local Netherlands. Now come to this new regime. Now in this new regime, 100 is the dividend. There is no need to pay this 20 dividend distribution tax. The local company will deduct 10 rupees, 10 euro as the withholding tax, and they will pay the balance 90 to Netherlands. And on this 90 which they receive, they will offer that for local taxation in Netherlands as per the local law.
Okay, thanks. There's still a number of questions that I try to bundle maybe, or that can also be asked afterwards. There's a question of how we work together, Praveen. So basically, I can answer that. Basically, we are the Dutch contact point for M+V in the Netherlands and in Belgium. So whenever there's a question, of course, you can reach out to me, and I'll get the right people on the Indian side, because I see also another question that's more about permanent establishment. Praveen, is that something where you can say something about, or is this more something for group? One of our colleagues.
On this permanent establishment, yes, over here, actually, before I answer that, I actually need to know what type of operations that we are having, and only then I can really answer really with that operations. Really, the permanent establishment is there, or there is how some steps can be taken to prevent the creation of permanent establishment. So I will request some more detail about how the business is getting entered into India. What are the more information around that? So then actually I would be able to give you the much more really direct answer for this query. So if we can have that arranged, I can answer that.
Yeah. And now there's more and more questions coming in. So also about some more legal stuff. But so again, M+V has a whole team of experts. The contact person in the Netherlands, that's me and my partner Bart Massa. But for the end of this presentation, there's also my details. But all of you have my details. So I basically, based on your questions, I select the right people on the Indian side to answer the questions best, and we can plan like follow-up meetings via Zoom or whatever to go into the details. Let's see what is there. How can an acceptable for tax authorities IT fee or / management fee be defined? So this is, I think, referring to the transfer pricing. So how to define yeah.
So this IT fees or management fees can be paid. It's a very because some services are actually getting delivered by the parent company for this. If certain services are getting delivered for this IT and management services, and we had the intercompany agreement in place, and the prices which are getting paid for these services are under the preview of transfer pricing. They are getting qualified using any of the methods. So then I don't foresee any risk over there. So IT authorities normally go for the documentation, they go for the evaluation, and they go for the substance. Is there any service delivered or not? If everything is there, so then I foresee as such. I don't foresee any risk on this type of transactions. It is very normal business transaction which happens between the two entities.
Okay, I see. I see already also people leaving. We're already over time. I suggest to finish this meeting and just to say thanks to everybody. Thank you to you, Praveen, for explaining. We will send you the audio file, and if you have any more questions, please don't worry. Just get in touch with me, and we can plan an individual call with Praveen, or if you have more questions on other topics, we can also get our legal advisor on board. So for now, thanks again all for being there, and have a great day. We'll be in touch. Thank you. Thanks, Praveen.
Thanks, Martin. Thanks, Atul, for organizing.